Introduction. In traditional capital budgeting, investment decisions are typically assessed using tools such as net present value, NPV, internal rate of return, IRR, and payback period. However, these models assume that project parameters remain fixed and decisions are made at the outset, ignoring the reality that managers can make future decisions that alter a project's direction. This limitation gives rise to the concept of real options. Real options introduce flexibility into the capital budgeting process by treating investment opportunities as financial options, much like those traded in markets where firms can defer, expand, contract, abandon, or switch investment strategies based on how future uncertainties unfold. This module explores the types, valuation, and strategic significance of real options in capital budgeting and how they create value beyond conventional NPV estimates. Definition and core concept. What are real options? A real option is the right, but not the obligation, to undertake certain business initiatives such as deferring a project, expanding or scaling up, abandoning a project, switching inputs or outputs. Unlike financial options, real options deal with tangible assets and managerial decisions, rather than stocks or securities. Types of real options. 1. Option to defer. Timing option. Postponing the project until more information is available. Useful in uncertain environments or volatile markets. Creates value by avoiding premature commitments. Example, waiting to launch a product until market testing confirms demand. 2. Option to expand ability to scale up operations if the initial phase performs well. Seen in staged investments or pilot projects. Adds value by capturing upside potential. Example, launching a single outlet with plans to expand to 100 if profitable. 3. Option to contract. Reducing the size or scale of a project in response to adverse outcomes provides downside protection. Example, cutting production by 40% due to falling demand without total shutdown. 4. Option to abandon. Terminating the project midway and salvaging residual value helps avoid further losses, especially valuable in volatile or speculative industries. Example, selling machinery and exiting an underperforming plant. 5. Option to switch. Flexibility option. Flexibility to switch inputs, outputs, or processes based on external factors. Mitigates risk from price shocks or regulatory changes. Example, switching between oil and gas in a power plant depending on prices. 6. Growth option strategic investments that enable future projects. Cannot be valued directly using cash flow methods. Value lies in strategic positioning, not current income. Example, acquiring land in a developing area for future projects. Valuation of real options. Real options are valued using option pricing models, particularly A. Binomial lattice. Model time is divided into discrete steps, nodes. At each node, values move up or down with probability. Suitable for simpler options, used to estimate values for abandon or expand options. B. Black-Scholes model, popular in financial markets. Based on continuous time framework, requires parameters such as volatility, risk-free rate, time to expiration. Challenging to apply directly to real assets due to assumptions. C. Decision tree and scenario modeling. Visually maps out decisions and probabilities, especially useful in early-stage investments, or R&D reflects multiple paths and strategic choices. 1. Feature 2, traditional NPV. 3. Real options approach, flexibility. Non-high future decisions ignored explicitly included risk treated via discount rate, modeled via probabilities, volatility, value of uncertainty. Seen as risk, seen as opportunity focus, static cash flows, dynamic managerial response. Traditional NPV often undervalues projects by ignoring managerial flexibility, which real options can capture. Strategic importance of real options encourages learning and adaptability, promotes strategic investment sequencing, enhances competitive advantage, useful in industries like energy, pharmaceuticals, tech, and infrastructure, challenges in real options analysis. Complexity, advanced modeling and data required valuation difficulty. Estimating volatility or probabilities is difficult. Lack of standardization, No universal method across industries. Managerial biases. Overconfidence or pessimism can distort flexibility use. Summary. Real options provide a powerful tool in capital budgeting by valuing the flexibility inherent in managerial decisions. When applied properly, they transform investment analysis from a static evaluation into a strategic, dynamic process. While challenging to implement, the insights they offer can lead to better informed, risk-aware, and forward-looking decisions.